Big tech is preparing to spend $700 billion on AI infrastructure in 2026, a sum that exceeds the entire projected economic output of Israel. In the world of high finance, there are bets and then there are generational gambles. In 2026, the titans of big tech, Microsoft, Alphabet, Meta, and Amazon, are placing a bet so large it exceeds the projected economic output of the entire nation of Israel. We are talking about a combined capital expenditure, or Capex, approaching $700 billion in a single year. To understand the scale, Capex is the money a company spends to buy, maintain, or improve its fixed assets. In this case, the assets are the physical backbone of the artificial intelligence era mammoth data center, high-priced GPUs, and the specialized networking required to link them. This isn't just a budget increase. It is an infrastructure arms race. The four hyperscalers, the massive cloud providers that lease computing power to the rest of the world, are increasing their spending by more than 60% over the historic levels of 2025. But this surge comes with a steep price. For the first time in years, the industry's most profitable companies are facing a crisis of cash flow. The cash flow as a cash company generates after accounting for the money spent to maintain its assets. It is the ultimate measure of financial health, and it is plummeting. Amazon is the most aggressive, planning to spend $200 billion this year. The result? Analysts at Morgan Stanley and Bank of America project Amazon's free cash flow will turn negative in 2026, with deficits ranging from $17 to $28 billion. Alphabet isn't far behind, with Capex reaching up to $185 billion. Pivotal Research Project's Alphabet's free cash flow will plummet nearly 90% this year, dropping from $73.3 billion in 2025 to just $82 billion. There is Meta. The social media giant raised its Capex guidance to as high as $145 billion. Barclays analysts described the prospect of negative free cash flow for Meta in 2027-2028 as somewhat shocking. Even Microsoft, while growing at a slower rate, is guiding calendar 2026 spending at roughly $90 billion. To fund this, the companies are raiding their war chests. Together, the four leaders held over $420 billion in cash and equivalents. But for some, the cash pile isn't enough. Alphabet's long-term debt quadrupled in 2025 to $46.5 billion, including a $25 billion bond sale in November to fund its expansion. The mechanism driving this spending is a brutal cycle of supply and demand. The modern AI data center is no longer a simple warehouse of servers. It is a high-density production system. Morgan Stanley notes that per gigawatt build costs are rising by 20%. This is driven by bottlenecks in high-bandwidth memory cooling systems and power distribution. It creates a self-reinforcing loop. Surging orders deepen shortages, which lift prices, which encourages companies to order even more to avoid being left behind. This is strategic signaling. If a hyperscaler slows its investment, the market may interpret it as conceding the AI race. But the strategies differ. Microsoft and Alphabet are building for the enterprise cloud and search. They can point to multi-year contracts from corporate customers. Meta, however, is betting on personal superintelligence for billions of people. Meta doesn't sell its compute to others. Every dollar spent on GPUs is an internal bet on ranking, ads, and future consumer products. This makes Meta's bet riskier in the eyes of investors, as the return is harder to underwrite. Then there is Apple. Apple is the outlier. While the hyperscalers spend hundreds of billions, Apple's full-year Capex is expected to be around $14 billion. This isn't because Apple isn't investing in AI, but because of its architectural choice on device inference. Apple Intelligence runs primarily on Apple Silicon inside the iPhone or Mac. The cost of that compute is built into the device's bill of materials, not listed as data center Capex. When Apple needs cloud-scale power, it partners rather than builds, such as using Google's Gemini to power Siri. The question now is whether this is a structural transformation of the global economy or the largest bubble in tech history. For now, the CEOs are doubling down. Meta's CFO Susan Lee stated that the highest order priority is positioning the company as a leader in AI. They are building a moat of silicon and concrete, betting that the future of intelligence is worth $700 billion of today's cash.